Live from Singapore, welcome to our new show, diving deeper into the stories that matter with crucial context and sharp analysis. This is Inside with me, Haslinda Amin. Now, Chinese markets failed to get a lift despite banks slashing lending rates by more than expected, the latest in multi-front efforts to give the economy a push. Carson Block made his name shorting Chinese stocks and still sees no reason to like them. Is there anything that Beijing can do to change his mind? We'll ask him in just a few minutes. We'll also speak exclusively with IEA Executive Director Fatih Birol about threats to global energy supply as tensions flare in the Middle East and how nuclear power is making a comeback thanks to AI. Meanwhile, Malaysian politicians commit to rolling back fuel subsidies even at the risk of stoking inflation. We hear exclusively from Economy Minister Afizi Ramli, who says they're prepared for any backlash in a country where vehicles outnumber people. China's moves to support its ailing economy and markets continue, with its banks slashing benchmark lending rates by more than investors and economists were expecting. They're taking cues from officials who've implemented a host of measures to revive growth and put a floor under the housing market. The PBOC has already signaled that more easing is on the cards, including lowering the reserve requirement ratio. Now, just over a month ago, going short Chinese stocks was one of the world's most popular trades. Fast forward to now, bullish China is one of the most crowded positions after Beijing's stimulus blitz stoked a short-lived rally. Well, our next guest became famous back in 2011, shorting Chinese companies at a time when they were the Wall Street darlings. Joining us exclusively now, Muddy Waters founder Carson Block, sometimes called the king of short selling. Carson, good to have you with us. It seems like China is a great spot to start because you started short selling Chinese companies back in 2011, the likes of Sino-Forest, iQIYI, Luckin Coffee, and you're still not liking China, even though we've seen a slew of measures, policy changes and efforts to perhaps, have more transparency. Why is that?
Sure. Well, I come at China mostly from the U.S. listed China stock perspective and to a lesser extent, Hong Kong. But the reasons why I have been calling China uninvestable in terms of the equities since 2010 have to do with governance. And so particularly for the non-mainland listed equities, the governance was always a problem because it was, especially for U.S. listed ADRs, for people who, in China, managers who wanted to commit fraud, it was a heads I win, tails I don't lose proposition, because the U.S. has never actually materially disciplined a confirmed fraudster from China. So you had that issue of governance. But then you overlay the capriciousness of China's policy. And we began really seeing this around 2018, 2019, when China began just turning dials and all of a sudden deciding that it was going to zero, effectively, for some period of time, the for-profit education industry. And then Didi Chuxing, which was about to go public, and Alibaba's Ant Financial. So you now have this, so you have that capriciousness of policy, and that has gotten worse. But the other thing that foreign investors in particular didn't understand, or took them a long time to understand, is that China doesn't view itself, at least at the policymaking level, as on a long-term basis needing foreign capital. So every now and then they'll say the right things, and there's history of this. They'll attract foreign capital, and then they'll help incinerate it. So on top of the governance risks, the capriciousness of policy risks, you also now have the geopolitical risks. Xi has been pretty clear at times that, and something that I thought was never actually on the table a few years ago, that China might try to take Taiwan by force, that is, I think, on the table. So there were previously, again, just for governance reasons, if you own these stocks and you're in the US, you could wake up one morning and, one of the companies is a zero. Then with capriciousness of government policy, several of your stocks, you could wake up and find them to be zeros. But now with the geopolitical risk, all of the China equities you own, you could wake up one day and they're zeros because war has started. So from a medium to long-term perspective, I once again just still fail to see how having money committed to China makes sense. Now, on a short-term basis, I don't have an opinion. So if you're long China because you get that it's a trade, okay, great. Reasonable people can disagree on that. I'm not going to argue with that. But if you're thinking of marrying this, that's a path that a lot of people have been burned by before. And I wouldn't think that this time would be different.
So, Carson, China is a trade. It is not an investment. I just want to put it out there as well. China does need foreign capital right now. And when it comes to transparency, accountability, governance, it is really trying to address that. We've seen a lot of reforms, yet you say it has not done enough. Would you say it is in the right direction?
Well, okay, from a very long-term perspective, there are two things that I think Xi has done at a very high level correctly. So number one, the fixed asset bubble. I mean, it was no secret for over 20 years that there's a massive fixed asset bubble. And every now and then, policymakers, particularly under the Hu Wen regime, they would talk about how they need to rebalance the economy. And they would start to do that. They would tighten up on lending to property and other consumers or other deployers of capital into fixed assets. And then they would look at the data, the lights flashed red, they stared into the abyss and they lost their nerve, and the taps were open again and the bubble continued to inflate. So Xi, probably because he's been able to perfect population control measures during COVID, has felt that he has the ability to really tighten the screws and prick that bubble in a way that he previously didn't, and the government before he became chairman did not feel. So from a long-term perspective, that's good. That's necessary to reset the balance in China's economy. The other thing that he's done that's smart is his focus, or he's had the focus on technology go away from that traditional, consumer-led technology, SaaS, online, et cetera, into real hardcore industrial technologies. So from a strategic perspective for China, that's beneficial. But, in terms of, yes, China wants foreign capital right now, but the moment that she feels that doesn't need it or that the costs of it outweigh the benefits, foreigners are going to be horribly abused. Again, this movie plays repeatedly.
So what would it take for you to change your mind? What would it take for China to be investable?
Well, look, I'm obviously never the person
are you
to ask
just
that question
not
to.
liking China at all? No matter what China does, you're not going to like it. I mean, is that a fair assumption to make? Is that the real picture when it comes to Carson Block and China?
Well, I've always considered that the domestic equities were different from a governance perspective than the offshore equities, particularly the U.S. equities. There was always more recourse. The heads I win, tails I don't lose equation doesn't necessarily exist with domestic onshore equities. So that's something that we haven't looked at before. But if you're looking at buying Chinese equities in the U.S., that governance risk is always there. I don't believe the numbers. I do trust the numbers, or much more likely to trust the numbers onshore. But at the end of the day, China, in contrast to, say, Vietnam, which we are very constructive on, doesn't feel like it really needs foreign capital. And I don't think it intends to be accommodating to foreign capital on a long-term basis.
Okay, let's talk about the U.S. Overvalued some say. We've seen, 47 straight sessions of record and the most expensive in decades. Is that something to be concerned about?
Well, there's a debate as to what really drives, when you talk about the U.S. market, especially the S&P 500 or the Mag 7. I'm in the camp that, although I don't have the facility with math to really try to prove this out, but I'm in the camp that believes that what drives that index are flows. And so at the end of every month, U.S. workers, a lot of them, their paychecks go into their 401ks, which are retirement funds, and there's a robo bid for these stocks. And what happens is you reduce the effective supply of stock because you're taking out the active owners of stocks that will decide, hey, at this price I'm a seller, at a lower price I'm a buyer, and you're replacing that with a holder that will never sell unless and until it has outflows because people are drawing down their retirement accounts. So according to that view, as long as the labor market is reasonably strong in the US, which it is, you're not going to see outflows. You're just going to continue to see inflows, especially in those, in the most heavily weighted names in the S&P 500. So I have, in the past few years, I have looked back on my career as an activist short seller and, kind of done the math and felt like, well, I probably could have just been levered long the S&P 500, deferred my taxes, and gone through a lot less BS, and be in more or less the same position financially. So, I mean, that does make the market more fragile, but there's a Fed put, there's always a Fed put, does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much, just close your eyes and buy, probably Mag 7.
Carson, speaking of Mag 7, let's speak about NVIDIA. I mean, that's what's driving that sentiment and that rally that we've seen. $3 trillion market cap, we're talking about PE of 63. It's driving a lot of the other companies up as well. Are there companies which are unduly benefiting from that run we're seeing because of NVIDIA? Point them out for us. So,
not ready to do that. When we point them out, there's usually a full report behind that because, but we need that in case we get sued, which does happen quite a bit. But no, in every hype cycle, and AI is obviously the hype cycle, in every hype cycle, you get opportunists who have companies that are maybe semi-real, maybe not even that real, but they decide to take advantage of it because there's so much money chasing that. So yes, there will continue to be more. I mean, previously it was crypto, and there were a number of companies that were really dodgy in the crypto mining space or crypto adjacent spaces. So, I mean, and even the full-on crypto companies are probably pretty dodgy to begin with. But yeah, there will be a lot of people who take advantage of the AI hype cycle. You can make money as a trader there as long as you're in on the joke and you're not left holding the bag. But there will be painful bag holding eventually.
So there is a bubble waiting to burst, and if so, how soon do you think that might happen?
Well, I mean, that doesn't necessarily mean that it's a bubble. Look, I don't opine on NVIDIA. I've got two friends, each very smart, highly accomplished, and they've got a bet about whether NVIDIA is going to be down by 50% in the next, I guess another 9 months or so. They each make compelling arguments. I don't have a view, but I do know that there will be a lot of pretenders in the space looking to vacuum up the dollars that are being thrown into the space. And those are the ones that we will consider shorting.
If you're not opining over NVIDIA, are you opining of a Tesla? We've seen how, Elon Musk has unveiled his robotaxi, much anticipated, but lacking on details. Big plans, of course, that humanoid robot as well, that robo-van, lots of plans, but lacking details. Investors obviously not liking. We've seen how the stock has, has taken a tumble. What's your take on Tesla?
Well, yeah, I make everybody mad when I talk about Tesla, the bulls and the bears, because number one, probably nobody has ever played the public company game better than Elon Musk. And several years ago, the only letter I've ever written to investors, I had this epiphany about Tesla and Elon Musk. And, there is in life probably a need for a certain amount of gilding the lily. When it works, we call it chutzpah, and we applaud. Now, when it's too much, it doesn't work, then the person's Trevor Milton, and he's derided and occasionally prosecuted. Elon has this perfect balance between BSing and delivering. Okay, I mean, the cars drive, the rockets fly, the satellites work. He does these incredible things. Does he routinely overpromise? I mean, say things that it's hard to imagine he can say with a straight face? Yes, he does. But does that matter? Apparently not. So yeah, nobody's played the game better than he has. It is a volatile stock, but it continues to get flows, going back to what I said earlier, and will continue to get flows. And I think what everybody on the bear side missed about it, the arguments were, oh, Tesla doesn't have the scale, it can't compete with Toyota, Volkswagen, blah, blah, blah. And that's true. They didn't have the sales base scale or the manufacturing scale. But what all of the bears missed, and was what my epiphany really was in 21, was that Elon understood that the base the scale he needed to have was capital base. And so when he was able to yoke that stock price way up and have this enormous market cap, I mean, even if the company's bleeding billions of dollars and the stock is sinking, there's so much market cap that he can continue to raise money, and Tesla's not going bankrupt for a very long time. And that's what the bears missed, because the bears were hung up on this, oh, it bleeds money, it's going to go bankrupt.
Right.
And look, I was in that camp for a number of years, but no, Elon pulls rabbits out of the hat constantly. Look, it's one thing to bet on him or bet on Tesla, but I just won't bet against Elon. I did in a minor way several years ago. We had we had crash puts on Tesla that almost hit and paid off, but no, it's just, you can't bet against the guy.
If you take a look at Tesla stocks, right, Carson, I mean, big loser this year, but still trading at high multiples, PE of 61. The question really is whether Tesla's fundamentals can support this kind of pricing for the stock. Your take on that?
Well, my take is it doesn't matter. It's never mattered. And if you really scratch the surface on the earnings, I mean, a lot of that has to do with selling credits, carbon credits. So and Tesla's accounting has always been heavily criticized by the bears, and they're not wrong. And I'm not current on the accounting or the numbers, just to be clear, but it doesn't matter. And when you look at, it's amazing to look at the evolution of Elon Musk, right? He was once the darling of the political left in the U.S. He was seen as, an environmentalist, and now he's the darling of the political right, and it hasn't hurt. I mean, and he was, a lot of people now do compare him to Trump, and I think I think in terms of personality, there are a lot of valid comparisons. But what's interesting is when Elon started his jihad against short sellers, especially Jim Chinos, probably back around 2015, 16, if I remember correctly, just like Trump himself, when Trump was running for president, Elon recognized the potential of a populist movement. So he created this whole sort of market populist movement, the sentiment that, hey, by buying my stock, you are sticking it to these, powerful, shadowy short sellers. And, back then I didn't understand why he was so fixated on short sellers. And I thought it was just some, thin skin or, easily bruised ego. And that could be true, but I think it was really strategic that he understood that by setting up this plot of good versus, purportedly evil, he could get people to buy the stock. And that is part of the reason why you don't bet against the guy and why nobody has played the game, the public company game, better than Elon Musk.
The thing is, Carson, he's aligned himself so closely with Trump. Is there a risk to that?
Yeah, people thought so back then, but I don't think so. I mean, it's look, the guy's incredible. I mean, I don't say that as a fanboy, but it's now. I once thought that would be a risk to the brand, but America is pretty evenly split. The world is pretty evenly split. So, if the left isn't going to buy the cars, then the right's going to buy them. And if you went back to 2015 or 2016, the right would scoff at the idea of electric cars, and now they love Elon Musk. And for them, buying a Tesla is a bit of a symbol of supporting libertarianism or or right-wing populism. So I don't think it matters for the brand.
I just want to put it out there, though, that once upon a time you did say that Elon Musk is a liar. Yeah.
Well, he does lie. Yeah, I think I just said that a few minutes ago. Yes, he does lie, but there's enough truth in what he does. Again, the rockets fly, the cars drive, the satellites work. So he has this perfect balance between lying and deception and delivering and truth. The perfect balance for this moment in time.
A lot of eyes on the U.S. election. Does it matter who wins for the financial markets? Would, a Trump administration be better for the stock market, or would it Kamala Harris?
Well, I'm going to answer that with some nuance. I think if you're in the finance industry in America, Trump is definitely better for you. Does it matter to the markets? Again, going back to my view that they're kind of on autopilot effectively, or at least, the S&P 500 is because of flows and just excess liquidity. I mean, even with the Fed having raised rates, there's still so much liquidity in the system that you see, to me, I'll never understand what the actual value of Bitcoin is, right? It's a currency without a country. And if there's any intrinsic value, it's well beyond that. So that just shows you there's still so much liquidity in the system. So I don't see Kamala winning impacting that. But definitely Trump makes finance somewhat less crappy to be in as an industry. Somewhat. You can't really put the toothpaste back in the tube, given how far we've come in terms of onerous legislation, rules and regulation, but he'll make it somewhat less onerous.
I want to touch on Vietnam. What's a short seller like you betting long on Vietnam? Earlier, when you talked about how you're taking issue with China because of, transparency, governance, accountability, the same issues do apply with Vietnam.
Well, I'll obviously take the other side of that. Look, with China, I've lived there twice. I've done about 6 years in country. I was living there again from 2005 to 10, and that's when I started Muddy Waters. And I started it kind of effectively by accident. But at the time, I started it and realized that, my God, there's this whole world that has no idea. They throw all this money into China and they have no idea what's going on. It was stunning to me that there was such an information disconnect and such a disconnect between perceptions of foreigners as to how business is done in China and what really goes on. And then in 2017, I was going around saying, hey, Trump became president. And so many aspects of the U.S.-China bilateral relationship are underwater, but in the markets, that's not yet underwater. And everybody's really excited about Chinese stocks. But 2020, when COVID hit, that was a breaking point. And so I said to myself, this is going to be different. This is going to be the time when finally the West has a real serious break with China. And it's going to be the biggest geopolitical realignment since World War II. And it's all going to involve countries' relationships to China. And so the winners in that world, or in this world that we're in, are the ones that are non-aligned. So India and Vietnam. And, you know, Vietnam's never going to be the US's ally, but it's definitely not going to be China's ally.
Right.
And so with
Carson,
FDI...
time is quickly running out. I have to get this in. I want to take a look at the outlook for short selling. You've said before how, you know, you feel like a gun is pointed at short sellers and that your years as a short seller are pretty numbered. Talk to us about where this is going, and might it be the end for you soon in terms of short selling?
So what you're referring to is actually, I think, that was an article that a couple of Bloomberg print journalists wrote a couple of years ago. And we took issue with that because they spent an entire day with me, and I think they took that somewhat out of context. Look, really excited about our Vietnam Fund product, but that doesn't mean that I'm getting out of short selling. We're doing things in resources, mostly on the long side. Doesn't mean I'm getting out of short selling. It's a difficult time for short selling, but yeah, right. I mean, I'm still coming to the office and, you know, long and strong Vietnam.
Carson, we have to live with that. Thank you for joining us. Carson Block, Muddy Waters Capital founder and CIO. This is Bloomberg. Stay with us. Welcome back. You're watching Insight. Now for the latest on tensions in the Middle East, Israeli Prime Minister Benjamin Netanyahu has met with top security aides to discuss an attack on Iran. It comes after a Hezbollah drone penetrated air defenses on Saturday and exploded next to Netanyahu's private home. Israel, meanwhile, has launched a military operating targeting Hezbollah economic strongholds in Lebanon. A particular target is a financial institution used by the Iran-backed militant group and its leadership. And here's a look at how oil and gold prices are reacting to the latest developments. Brent crude climbing higher above the $70 barrel mark, with WTI holds steady around $69 and safe haven gold touching a record high above $2,700 a barrel. Now, crude has been a volatile trade given the worries around the Middle East conflict, but other pressures are keeping prices within a narrow range, well below the historic highs of more than $100 a barrel, including China's weak economy. Let's unpack these dynamics with IEA Executive Director Fatih Birol joining us exclusively here in the Singapore studio. Dr. Birol, good to have you with us. Oil hovering at about $70 a barrel, even though we're seeing escalating tensions in the Middle East. Some say it's the worst we've seen since October 7th, more than a year ago. What's your take on why oil is at such a level?
So first of all, I believe most of the countries around the world are happy that the oil prices don't go up. So we shouldn't complain about this. In fact, it's a structural issue. As you rightly ask or underline, in the past, when such a geopolitical tension took place in Middle East, even 1/10 of it, we have seen oil prices going almost a triple digit. Why it is now different, although tension is much higher and the risk of escalation is very high? There are two reasons for that. Number one, as International Energy Agency has rightly expected, this year global oil demand is very weak, much weaker than previous years, and we expect this will continue because of one word, China. China in the last 10 years was responsible more than 60% of global oil demand growth. China was a very strong economy, and China is slowing down China's economy. Therefore, China needs less oil. And the second one is the penetration of electric cars around the world, in China, United States, Europe, and elsewhere. As a result of that, we are seeing the oil demand to be weak. Plus, second one, oil production from Americas. We call them American Quartet, US, Canada, Brazil, and Guyana is very strong. The demand, when I compare the demand this year and the production growth only from these 4 countries, more production comes from these 4 countries than the global oil demand growth. So therefore, a lot of oil is in the market. Demand is weak. Therefore, we don't see a big jump in the prices. But of course, if the escalation is much bigger, it can be a different story altogether.
Has oil demand peaked? I mean, we used to see about, what, 2 million barrels a day?
Exactly.
Are those days over?
I think these days are over. There may be ups and downs, but in general, we think global oil demand will peak before 2030. Again, China is a big driver of this global oil demand growth. China was the engine of the global oil demand growth, and this engine switches to electricity now. Therefore, we expect that the global oil demand will be weak, and before 2030 it will peak. But afterwards we still need oil, of course.
The world awaiting Israel's response to Iran's attack, and some say it might attack Iran's energy facilities. Should that happen, can the excess production that you talked about from the likes of the US, from Canada, compensate for the destruction perhaps of Iranian output?
First of all, I very much hope that the situation in the Middle East doesn't escalate further. But if it happens, if there is a major damage on the energy infrastructure, especially that of oil, this can push the prices up. However, we have a lot of oil, again, from the countries I mentioned, and plus, the countries in the region have a spare production capacity that they are not using. It is ready to be used, and they may bring this oil to the markets if they wish so, to comfort the market. So there will not be a problem of the availability of oil, but as a result of the geopolitical tensions, we may see some spikes here and there.
So in terms of oil prices for the future, the outlook of oil prices, they should be trending downwards, given that demand destruction is there, given that there's enough supply to cover any damages. Is it fair to say oil prices are headed down?
It is exactly the point. If we didn't have these geopolitical tensions, I would have thought that the prices would be even lower than what we have now. WTI is less than $70, and we could have seen lower. And the same, in fact, the same scenario, or a similar scenario, we will see soon for natural gas. Because, and this region, very important for this region and for the world, a lot of, starting from 2026, 2-3 years, a lot of new LNG gas will come to the markets. Qatar, United States, huge, a big wave, and this would also change the markets, gas markets, from the markets of sellers to buyers, and this will also put downward pressure on the natural gas prices.
Dr. Birol, we have to perhaps look at the influence of AI and data centers. They're consuming massive amount of energy, and that's pretty concerning to the rest of the world. How might that add to energy demand?
Yeah, so AI is, of course, very topical nowadays, and we look today of the entire electricity consumption, the share of AI, because electricity is consumed for lighting, for electric cars, for refrigerator, everything. The share of AI is less than today 1% in the global electricity mix. It will grow, but it will not grow globally. There will be some the regional. It can be in Wyoming, it can be in Singapore, it can be in this or that country. So globally, it will not be a major game changer, but it will add to the electricity demand globally. In addition to many other drivers I mentioned. And
is there a percentage? Is there a number you can give us in terms of how it would boost energy demand by
I think 2%, it is still 3%? Too early to give a number, but today it is only 1% of the global electricity consumption. It will not be a big game changer. But what is a game changer is electricity is used more and more in everything, in the cars, in industry, at home. So what we are seeing is we had after this the industrial revolution, we have seen the age of coal. And we are now seeing the age of oil. We are still there. It will be with us oil many years to come. But the world gives the signal that we are entering the age of electricity. Electricity will be more pronounced than maybe oil and gas. We talk about the oil prices. We will, in the future, we may talk about the electricity prices.
But isn't it the age of nuclear power? We've had the likes of Taiwan saying they're open to it. We're seeing the U.S. changing its stance on it. We're looking at Japan and Korea pretty open to it as well. I mean, how do you talk about AI without talking about nuclear power?
You are right. I mean, if we say the age of electricity is starting, there are mainly two sources to meet that demand from electricity. One is renewables, the other one is nuclear power. I am seeing that in the entire world, the nuclear makes a very strong comeback, both in terms of the large-scale power plants that we have seen in the U.S., in Japan, and elsewhere, and the second, more and more interest in the small modular reactors, smaller version and more flexible version of the nuclear. So nuclear is making a comeback. There is no question about that. The countries that have nuclear power plants, they are extending the lifetimes of the nuclear power plants, building new ones, and many countries who never had a nuclear power plant in their countries are now planning to build nuclear power plants because nuclear power generates electricity without any interruption. You push the button 24/7, no emissions, and it's a very secure one. So,
but there are risks to nuclear power.
There are risks to everything.
How does it shape? How does it shape the energy mix?
I expect that the nuclear will grow, and our numbers show 2025, next year, we will see the highest nuclear power generation in the history. And this is a good thing, I believe, for the world. But we should also note that in the last 5 years, about 80% of all new nuclear power plants built in the world was in China. 20% everybody else put together. China alone, 80%. But I expect now it is going to change. And in the United States, in Europe, in Asia, we will see, in Africa, we will see a new nuclear power to be built. But for the nuclear power plants, you need many years to finish a project. If it is solar for 2 years, nuclear takes at least 10, 15 years.
How are you assessing the risk of nuclear power? If a country like Japan can have accidents, some say perhaps emerging economies may find it difficult monitoring, keeping a lid on troubles that could appear from having nuclear power in the country.
But to build a nuclear power plant, you cannot build a nuclear power plant just you are building a cottage. Nuclear power plants, there are some international rules and regulations. There are safety rules, and they are very strict. And the governments need to take all of this into consideration to be able to get a permission to build a nuclear power plant. So there are safety rules there. But the problem is, for me, for the nuclear, the biggest challenge today in front of nuclear, how are we going to finance nuclear power plants? Because their financement is very high. The down payment is very high. It is the reason we are coming with a new report mid-January, how to finance nuclear power plants in this age, because it is different in China, but different in the rest of the world, how you finance these huge projects which require a lot of capital.
The focus now, Dr. Birol, is on getting to net zero. There are questions whether or not we're on track. If you take a look at what hedge funds are doing right now, they're actually shorting green energy. They're going long fossil fuels. I mean, what's the takeaway from that? What are you seeing on the ground?
So I don't know what the hedge funds do, but I know what the planet wants from us. Yes, exactly. So they may change from one day to another, but what the world needs from us to keep our fragile equilibrium of our planet. Otherwise, the extreme weather events we are seeing will be much more frequent and much more intense, and it will affect everybody. So therefore, we have to reduce our emissions. Therefore, we have to use more clean energy. And in
Are
fact,
we on track for 1.5?
we are not on track. We are
We're
currently
not
on track for 2.4 degrees Celsius. And the difference between 2.4 and 1.5 degrees is not that you just take your jacket off and you adjust the temperature. It will have catastrophic implications for our planet. So therefore, we have to use much more renewables, nuclear power, electric cars, much more efficiency. And the more coal we have, the more fossil fuels we have, the more we make our chances to reach the climate targets difficult.
The thing is this, Dr. Birol, when you take a look at Asian economies in particular, they're looking for more investment in gas.
Yeah.
That basically will undo the targets that you're setting. I mean, how are you looking at developments here?
So in this part of the world, we see the appetite for gas, but appetite for solar as well, for offshore wind, for electric cars, and even for nuclear power. So there will be a mix of this, all of these energies, and this region will grow very strongly. Part of the most of the world don't see how important the Southeast Asia is. I give you one number. In the next 10 years, the growth, energy demand growth coming from this region is the second to India in terms of its global impact. 25%, 1/4 of the global energy demand growth in the next 10 years will come from this very region. So it is very important what kind of decisions will be made in this region. It is the reason I am in Singapore today to inaugurate the IEA's first office outside of Paris, and to look after the Southeast Asian countries and to work with them. I am just opening it tomorrow with the Prime Minister Lawrence Wang, and I am very happy with that.
Dr. Birol, just one follow-up question before we let you go, and I'd be remiss not to ask you this. If you take a look at the 6 months to 12 months basis, where do you see oil trading? What's a sustainable level?
So if we don't see a major escalation of the situation in the Middle East, I still expect that the oil prices will be further under pressure, because we are entering a period, including next year, more comfortable markets, lots of production coming from Americas. Demand will be still rather on the modest side, so I would expect further downward pressure on the oil prices.
Dr. Birol, always a pleasure to have us, to have you with us, and of course for our new here. We'll see you back pretty soon, hopefully.
Thank you.
That was IEA Executive Director Fatih Birol. And speaking of oil, Malaysia's government is bracing for public backlash as it commits to rolling back petrol subsidies in mid-2025. The move is politically sensitive and a long-delayed pledge that's key to convincing investors it's serious about fiscal reform. I spoke exclusively with Malaysian Economy Minister Rafizi Ramli just after his government announced its latest budget for the coming year. Rafizi weighed in on the key measures from its spending plan that's getting a lift from a growing economy and strengthening currency.
At the very least, we must be growing at 4%, at the very least, because I think that's the bare minimum potential. The challenge is always, what do we do to push it higher? Closer to 5, beyond 5.
If all your cylinders were to fire at the same time, we'd be looking at Malaysia growing at 6, even 7%. Is that a possibility?
It is a possibility, but there's a but to it. I mean, I don't want to throw something without really looking at the trajectory. I think we do have some path to go through before we can sustain that kind of higher growth, But to me, at the very least, we should be aiming to grow at 5% each year. That should be a realistic.
That's conservative. Is that conservative?
Yeah. So if we don't grow at a high force towards 5, then I think we have a lot of work to do to unlock the potential. If we are able to do at 5 for the next few years, it will give us enough time to build all the other capacities for us to jump to the next level, which is 6%, hopefully.
Malaysia has been making a lot of headlines in the semiconductor space. The Prime Minister has been very busy convincing investors to invest in the country in this sector. Give us a sense of the kind of growth you're anticipating and the big picture plan for semiconductors in Malaysia.
Our biggest preoccupation now is to make sure that we localize the industry. So, you have a few levers. We have a lot of demands for data centers now. Of course, data centers go through its life cycle, and then it has to replenish its servers, its chips, its racks. And we are also very good with the back end. Our preoccupation now is building our strength throughout the value chain.
Building an ecosystem.
An ecosystem. I mean, we have an ecosystem before, but it was very much limited by the back-end industry. And now with the presence of data centers, there will be a local demand for chips, especially for AI chips. And therefore, I think we want to make sure that hopefully we don't assemble chips coming from elsewhere, or the data centers here don't just import AI chips from elsewhere. We want it to be here. And we are working on it.
Higher up the value chain?
Higher up the value chain, yes.
When might this happen?
I think it's possible in the next 1 or 2 years. We begin to see, the first few batches of manufacturers or companies looking at Malaysia as a viable place to design and to manufacture everything here, because the demand from Malaysia and this region alone is also quite significant.
RON 95, petrol subsidies, a very politicized, sensitive issue for Malaysia. The Prime Minister has said that it will be rolled back in the middle of 2025. Give us a sense of the mechanism. How will that be rolled out?
What I can share is this. The whole idea is that we protect, at least 85% of the household, so that they won't have to go through any price increase. And those ineligible for the subsidy will have to pay the market price. We've more or less identified that perhaps a better way to protect lower income household is to have a two-tiered pricing.
Minister, the people are ready, Malaysians are ready for the unwinding of subsidies, because we've been here before and we've seen how Malaysians have been up in arms whenever we talk about RON 95. So you're confident that Malaysians are ready for this to be rolled out?
I think we are prepared for the choppy waters ahead. On the one hand, I think we have spent a long time preparing the masses, and we've put forth our argument, we've prepared at least infrastructure, the database and so on. So in a way, the public has more time to digest this. Yet, something like this, obviously, I think is a once in a generation decision that affects everyone's life. So obviously there'll be people affected and there'll be people unhappy with it, and people have to adjust their consumption. So I do expect a lot of noise in the beginning. My hope and our responsibility in the government is to make sure that we manage this properly so that it is sustainable. The policy shift is sustainable, and our society's view about the shift from a blanket subsidy approach to a targeted subsidy approach becomes part and parcels of Malaysian fabric beyond this administration.
It's hard to talk about the economies in Southeast Asia, in ASEAN, without bringing China into the picture, because a lot of FDI from China actually flows into the region, Malaysia in particular. We're talking about a slowdown in China, a sluggish economy that's really struggling to reverse that trend. How is that impacting Malaysia, and how is that I guess, being included in your own calculation when you take a look at Malaysia's growth?
It's, of course, the strength of China's economy impacts us directly, at least in the short term. Our currency does take a win from what happens in China. The trade numbers, our own exports and imports also will be affected by China. But I think that's the other side of the coin. With the slowing of China's domestic market, a lot of the companies, especially consumer products, electronics, high-end ones, have to look for different markets.
The China Plus One strategy?
The China Plus One strategy. I think in the past, a lot of Chinese companies contend that the domestic market was huge enough for them to grow without ever having to think going overseas. I think there is a rethink of that. A lot of these companies understand that with a lower kind of average growth in the next decade, it is better for them to find a foothold into the next big consumer market. And that's where ASEAN and its proximity and its culture...
So you're not too concerned about China's slowdown because...
I'm not too concerned. We have to manage in the short term, and that will affect us. We understand that. But there's a plus point to that. It comes with a lot of Chinese companies looking at ASEAN as the next market, and therefore I think we will be seeing more investments coming from China.
The thing is, Chinese companies investing in Malaysia carries its own risk in the context of US-China tensions. Those companies might just get in the crosshairs of tensions with the two, and Malaysia might just be paying the price for it.
It's a risk that we constantly looked at, and I think it's something that we have to build a certain framework for us to manage.
Malaysian Economy Minister Rafizi Ramli with those pretty candid comments. Let's take a look at the FX market. Take a look at where the ringgit is trading at this point in time. Of course, this is one of the best performing EM currencies in the region. Taking a look at where we are in terms of the ringgit, it is strengthening. We're also seeing strength in other currencies on the back of that pretty flat performance by the dollar. One in particular that we're tracking is the yen, 149.24. Currently, we're having the yen strengthened by 0.2%, inching ever closer to that 150 level, that psychological level. And of course, dollar yen at a critical juncture ahead of the BOJ meeting later this month. In terms of the overall picture for the stock market, MSCI Asia-Pac Index managing a bit of gains there, currently up by 0.2%. The Hang Seng giving up some of the gains we've seen in recent days, down by 0.5% gains for the TAIEX as well as the Kospi. Kospi leading the gains here, up by 0.8%. We're also tracking the Indian market, been trading for about 10 minutes now. It is contributing to gains in the region. Sensex up 0.5%. Nifty Bank Index also trending up by almost 1% as we speak. The rupee, 84.0625 is the level we're looking at right now. Now, before we go, here's a look at our guests for tomorrow. We'll get insights on markets and monetary policy with a so-called Wall Street seer, Ed Yardeni. Plus, U.S. Assistant Secretary of State Jeffrey Pyatt will be joining us to discuss Washington's role in Asia's energy transition. And that is it for Inside with me, Haslinda Amin. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.